When tax season rolls around, small business owners and anyone who files a tax return can get a little stressed out, trying to figure out what they can do to get a bigger refund or pay less to the IRS. Tax credits and tax deductions are two terms thrown around a lot when it comes to taxes. Their purposes can play a significant role when you file taxes, like saving you money, which makes knowing their differences crucial. Today I'm going to talk about the fundamental differences between tax credits and tax deductions, and then I'll go through some of the more common examples of each. There are key differences between a tax credit and a tax deduction. Both tax deductions and tax credits reduce the amount owed, but in different ways. Tax deductions will reduce the base amount of income that's taxable before your tax liability or the amount owed is calculated. Tax credits reduce the amount of tax owed by lowering your tax liability after it's been calculated. The second difference between a tax credit and a tax deduction is how many of each you can claim. You can claim multiple tax credits as long as you're eligible. Tax credits are either non-refundable or refundable. Tax deductions are available in two formats: itemized deductions and the standard deduction. You can only choose one or the other. Itemizing deductions allows you to claim specific deductions, but you'll need to complete a separate tax form. The standard deduction is another choice that may work for you. While you don't need to complete another tax form, the amount you'll receive for a standard deduction varies based on your filing status. Final main difference between a credit and a deduction is the possibility of a refund. You may receive a refund if you receive enough refundable tax credits. Tax deductions may not result in a refund unless deductions reduce your income to where you've overpaid through estimated tax payments or tax withholding. There are several factors that may make both tax credits or tax deductions considerable. Tax credits and deductions are both helpful, but there's one that's better for taxpayers. Tax credits are the more favorable option because they directly reduce the amount of taxes you owe. Tax deductions reduce your taxable income, but this is largely affected by marginal tax brackets. Here are a few additional reasons why tax credits are more beneficial. You can qualify for tax credits regardless of your income or tax liability. Tax credits are available as non-refundable and refundable. Non-refundable tax credits can decrease taxes owed to the IRS, and it can bring your tax liability down to zero. However, the IRS will keep the balance after having zero tax liability. Refundable tax credits can reduce your tax liability down to zero and even below zero. When your tax liability reaches below zero, you receive a refund. Individuals and small businesses alike can qualify for tax credits. Some common tax credits include the Child and Dependent Care Credit, allows taxpayers to receive reimbursements for their expenses for the care of qualified dependents. For the 2021 tax year, the IRS offers this credit as a percentage of up to $8,000 for one dependent's care expenses or $16,000 for two or more dependents. The Child Tax Credit is offered for child dependents under age 17 before December 31st who live with taxpayers for at least half the year. The credit is up to $3,000 for children aged 6 to 17 and up to $3,600 for children under 6. The Earned Income Tax Credit is a refundable tax credit available to low-income and moderate-income workers. The Premium Tax Credit is a refundable tax credit available for families and individuals that covers health insurance premiums offered through the health insurance marketplace. This credit comes with income requirements and must be filed with Form 8962. The Qualified Plug-in Electric Drive Vehicle Tax Credit ranges from $2,500 to $7,500 for new vehicles that are all-electric or plug-in models. The Recovery Rebate Credit is available for individuals for the 2021 tax year who qualified for but didn't receive the third economic impact payment. The Savers Credit is available for taxpayers who make eligible contributions to their employer-sponsored retirement plan or with an IRA. This credit amount will vary according to the adjusted gross income on your 1040. And the Work Opportunity Tax Credit is a business credit available for employers that expires in 2025. This is a credit for employers who hire employees in 10 targeted groups, and the maximum amount for this credit is 40% of up to $6,000. Whether you're an individual or part of a small business, you can also qualify for tax deductions. There are two ways of receiving a tax deduction. You can choose a standard deduction, which is a fixed amount to reduce your taxable income, or you can itemize deductions on your tax return. Deductions you can include are charitable donations, interest expense, medical and dental expenses, and other miscellaneous deductions. Small business owners can receive tax deductions for different business expenses such as charitable contributions, equipment, license and regulatory fees, taxes, and vehicle expenses. Figuring out which deductions and credits you apply for is the best way to lower your tax bill this season. If you miss deductions or credits that you qualify for, you'll likely end up leaving money on the table and overpaying in taxes to the IRS. When it's time for you to file your taxes, work with the tax pros at 1-800-ACCOUNTANT to lower your tax bill. We'll track down every possible deduction and credit and prepare your personal or business tax return with accuracy guaranteed, no matter how complex your situation is. We review everything with you and then file your taxes on your behalf. Enjoy peace of mind while the experts handle the complicated stuff.